Wednesday the 7th sees the FOMC step forward in a rate decision that's unlikely to grab any headlines in terms of any movement in rates themselves, but instead lays the groundwork for a potential period of massive easing in terms of monetary policy if we see the economics move a certain direction. So let's look into exactly the direction of the economics for the US right now, and also what the outlook could be for this meeting, the implications for the likes of the US dollar, the likes of US stocks, and gold. So first, let's look at the recent data that has come out, and it's a mixed bag, massively so. And certainly we've seen a number of so-called soft data points coming in weak over the course of the past month. That hasn't necessarily translated into the hard data all deteriorating, and that came most notably with the jobs report, which came in stronger than expected. So let's look over the course of the past week and a bit and see exactly how some of those figures have come out. So first and foremost, the job openings figure, that came in weak. The consumer confidence also came in weak, so not necessarily surprising on that front. Bearing in mind the job openings was March, the consumer confidence April. ADP also came in weak, so this provided the potential basis for us to think that we were going to get a very weak jobs report. GDP minus 0.3, so the possibility of a recession in the second quarter. Core PCE price index, weak inflation coming in at 0 for the month. So all of this points towards weakness. Then we see personal income, personal spending. They held up relatively well. It pointed towards US consumers not necessarily taking any drastic decisions right now based on sentiment, because of course right now we're looking at the potential for businesses to be taking actions, but will the consumers follow suit? Well, not at the moment as things stand. Then initial jobless claims, we saw that moving a little bit higher. The manufacturing PMI, it came in weaker, but it came in better than expected. And then we started to see the jobs report. So we saw better than expected ISM manufacturing PMI, which is something we thought was going to collapse in a pretty heavy manner, with that employment gauge in particular rising quite notably. Then we saw the payrolls figure 177, well above that 140K expected. Unemployment remained steady. The average hourly earnings weak, but at 0.2, it's not necessarily a huge move. Then we saw the services PMI that came in up at 51.6. So services, a massive part of the US economy. We've seen strength in terms of personal income, personal spending, the manufacturing PMI, the jobs report. So all of that paints a picture of a Federal Reserve that's probably not desperate to ease this time around, and certainly that's what markets expect, right? So we're not expecting sorry, it's not NFP predictions. This is their expectations for rates in the US. So you can see here 98% probability of no change this time around. But then looking further out, markets are now expecting the rate cut to first come in July. That was June not so long ago. And so you can see there has been some adjustments in terms of sentiment within the markets around exactly how much and when the Federal Reserve will be easing. And then you can look towards the back end of the year. You're looking at the possibility of us maybe moving towards a sort of maybe 3.25 to 3.5 range. So that would be 100 basis points, or maybe less than that. So 75 to 100 basis points. Now, not so long ago, we were looking at the possibility of 100 to 125. And you can see that here, right? So the move down to sort of 300 to 325 or 325 to 350, that has faded. And instead, we're seeing a bolstering of calls for less rate cuts. So 375 to 400. So that would be 2 rate cuts, or 370 to 375. That would be 3 rate cuts over the remainder of this year. Those are the 2 areas that have grown quite significantly. And so we're seeing an easing in terms of the expectations of quite what the Federal Reserve is going to do. In terms of the implications for markets, let's look at exactly what might happen. So interest rate probabilities tie up with the likes of the US dollar. You can see this close relationship. We have, of course, seen that stall of late, where the continuation of the weakness seen in the US dollar hasn't necessarily been alongside the moves for expectations when it comes to interest rates for the Federal Reserve. Nonetheless, we're seeing both of them sort of consolidating. So you would expect to see that relationship potentially coming back into play if we see higher expectation of easing from the Federal Reserve, that would point towards a potential for weakness for the US dollar. And conversely, if we start to see people expecting less rate cuts, so Powell being very patient in his approach, saying essentially, I'm data dependent, and right now the data doesn't say anything to mean that we're going to have to make a significant move in terms of the rate cuts, that could have implications going forward. Now, there's going to be question marks about what the perception is around inflation, because some members have said that essentially they're willing to look through short-term tariff-led inflation, and that would provide the basis for us to think we're going to see more rate cuts this year. And also, what's the perception around the direction of travel for the US economy? Of course, some of the data has already started to roll over. Some of the data not necessarily doing too bad and holding up quite well at the moment. But of course, we're sort of in the first innings when it comes to this data. So certainly it could deteriorate to a much greater degree. So a more dovish outlook in terms of the shift in expectations would likely cause further weakness in terms of the US dollar. So let's look at the US dollar and see exactly how that could play out. We're going to look here in terms of the likes of dollar yen. Dollar yen's an interesting one because we've started to see the likes of the US dollar sort of regaining ground of late against the Japanese yen, coming in around this area of support. So you can see here the sort of 140 mark, a potential key support level. We're rolling over once again. And so certainly, you know, as we sell off here, there's questions on whether we're going to bottom out once again at this level or not. So that's why it's key coming into this meeting, because if we break the 140 mark, it points towards this being a big topping pattern for dollar yen and the potential for further declines, particularly if we see a very dovish outlook from the Federal Reserve. If we see a relatively hawkish stance, it could lead to us to build a story around the potential for this to be a bottom for dollar yen. And in particular, if we start to see a rally up through this 151 level, that's going to give us greater confidence. That's so far away that let's look here in terms of the 4-hour chart. You can see this is probably a key level as well to be watching out for, 148.28. So as things stand, we've sort of retraced that. We're starting to roll over at the moment. We've come into a sort of relatively deep retracement between the 61.8 and the 76.4 fib. But for the time being, it looks like, you know, we could potentially be sort of creating this higher highs, higher lows. A break below 142, and in particular 140, would potentially pave the way for the bears to be back into play once again here for dollar yen. Now, in terms of the likes of here we go, the S&P 500, it's a similar kind of story in a sense, right? So we're seeing them tracking each other relatively well at the moment. And this highlights the story around the idea that if we see additional interest rate cuts, that could be perceived to be a good thing for markets. But markets aren't taking it that way, right? Markets are taking the idea of interest rate cuts, additional interest rate cuts, as a bad sign around the US economy. And therefore, if we see a relatively dovish outlook, there's a possibility that markets don't necessarily rally off of that news and instead say, well, the reason why they're so dovish is because they're very fearful about the direction of travel for the US economy, and therefore the multiples that underpin the S&P 500 and alike come into question. The direction of travel for earnings are going to come into question. And so it's not a given that a dovish outlook from the Federal Reserve is going to be beneficial for the S&P 500. Let's jump onto the S&P 500, and here it is. We can see that it's been regaining ground on this absolutely rampant move higher. 9 straight days of gains that ended yesterday, and crucially, it ended before we could take out the 57.86 mark. If we see that level taken out, then it looks like we're heading back towards record highs. But is there a justification for that right now? I wouldn't say so, quite frankly. So there's a possibility we start to roll over from here. This is the 4-hour chart. We'll look at sort of swing lows to be taking out to sort of tell us a story around the potential for this to weaken. So you're looking here at sort of 55.80 as your first swing low, then 54.32. But certainly, you know, it's starting to look a little bit pricey after that rally. And below this 57.86, there is a good chance that we could see the bears come back into play. I think there's a good chance that we have seen the bottom, but we've seen it extend towards the upside. The possibility starts to grow that we see a move towards a sort of 5,400, 5,300, if only to mark a retracement of this move here. And so you'd be looking into sort of this kind of area as a retracement zone. But like I said, so part of it's going to come down to what the outlook is from the Federal Reserve. If they start to point towards the need for additional rate cuts, then that could weigh on sentiment, given what that means about their outlook for the economy. And finally, this is a market that would likely benefit in the event of additional rate cuts, and that is the price of gold. Now, notably, we've seen gold pulling back over the course of the past fortnight, retracing around 8% from the 3,500 mark, just as equity markets push higher and the S&P 500 enjoyed a 9 straight day of gains, or 9 straight streak of daily gains. And so the question mark here is, if we see the weakness in terms of expectation for rates, so if we see expectation for future rates drop, so a dovish outlook and a pessimistic outlook for the US economy, what would happen in terms of equities? That would likely weaken it, as we've seen with our current relationship. But what would it do in terms of gold? Well, the weakness of equity markets has gone hand in hand with strength for gold. And if you look here, the relationship between rate cut periods and the trajectory for gold does point towards rate cuts typically coming at either the beginning or the middle of bull runs for gold. And that highlights, in my mind, the possibility of a protracted period of upside here for gold, despite the fact that, of course, it's already done very well. So if we see a dovish outlook coming into play from the Federal Reserve, that would likely bolster the likes of gold, which is already turning higher once again. If we look at that and you look at the likes of the S&P 500, let's say, we put it onto a new scale, then you can see here, if we look at, say, the 1 hour time frame, that's not necessarily perfect. If we invert it, so there you go. So we've got this inverse relationship at the moment between the S&P 500 and gold. And notably, we haven't even necessarily seen a significant pullback in the S&P 500, and gold's already charging higher once again. So it's sort of, it doesn't need much of an excuse to push higher once again. So if we see a dovish outlook coming into play for the Federal Reserve at this meeting, don't necessarily look to equities as the sort of main benefactor of that. Instead, I think gold would be the main benefactor. And with the rally that we've seen up through this initial swing high, which is the first one was here, 33.53, it looks like gold, in my mind, is likely moving back towards that record high of 3,500, which was tagged around, I think, the 22nd of April here. So certainly this is a key one to be watching out for. And ultimately, despite the fact that the Federal Reserve aren't likely to cut rates this time around, it's going to be a really interesting meeting because of what it says for the trajectory and the expectations of interest rates. And that then has knock-on implications for the likes of the US dollar, the likes of equity markets, and the likes of precious metals, most notably gold. Thanks a lot for listening. My name is Joshua Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading. Thank you.